we got these wonky revisions that were sort of released in the darkness late last week, which changes the comparisons a little bit. I know it's going to be weirder than normal. What are you looking for?
Well, they do this every year with the seasonal factors, and all it does is sort of it raised it in fact the revised numbers look at higher Q4 inflation that at the end of last year, although that was offset by lower inflation earlier in the year. It kind of just has to do with the spreading of the numbers over the course of the year. It didn't affect our numbers in terms of the forecast or expectations for today. It on the margin maybe put a little bit of downward pressure on our estimates. We're still looking for an overall gain of 0.4 and a core rate gain excluding energy of a high 0.3. It means it could be a 0.4. Honestly, though, Brian, the market has worked itself up in the wake of those very strong employment numbers and fearing an upside surprise on inflation. So the market is priced in a lot in terms of sort of bad news, if you will, on a high inflation print. I think if you got the numbers we're looking for, which are a little bit below consensus, the market would be quite relieved.
Yeah, Kevin, I feel like, and CalSTR's CIO, Chris Ailman, told us this in an interview we ran this morning. Feels like everybody's really in that soft landing camp.
Well, who wouldn't want to be? I mean, wouldn't that be a wonderful scenario? I think our base case is still that it would be a challenge for everything to work out perfectly. And to Michelle's point, if the CPI number today surprises to the upside, and I know that's not their base case, it could provide a little volatility into these markets because the idea that disinflation could be just such a linear perfection is difficult for me to get my head around. We saw service PMI come up a little bit. We've seen used car prices come up a little bit. So it's possible, just like last year when we saw CPI kind of punch us in the gut a few times, that this print could come in a little bit hotter than expected. And I don't think that's a break in the trend. I don't think that means that inflation is coming back. But we've had such a cooling period that if we get a number a little bit hotter than we're expecting, it could spook the market a little bit short term.
Yeah, I mean, Michelle, give us, you said 0.3, 0.4. I'm thinking Matthew McConaughey, Fugazi, whatever, Wolf of Wall Street. If it comes in at 0.3, I'm a little punchy, and I'll tell you why in a second. If it comes in at 0.3 or 0.4, does that make a difference? I mean, how much sort of delta in Wall Street speak are we looking for here?
Well, that's the thing. I mean, the market has, 10-year yields have risen about over 30 basis points. 2-year yields have risen over 40 basis points over the last week and a half or so. The market has moved a lot. And that's where if it comes in at 0.4 or something below that, even if it is, I would think the market could actually rally a bit in relief. If you get a higher number, a 5 or 0.6 number, a high core rate number, I mean, is the market going to start to price in a whole lot more Federal Reserve than it has, in terms of hikes than it has in the wake of that very strong employment report? It just seems to me the risk reward in terms of just the reaction to this number is a little bit skewed, given the fact that we've seen a pretty sharp sell-off in markets and already a change in expectations around how much the Fed has to do. And as I said, in the wake of those very strong employment, numbers of last week.
Yeah, I mean, Kevin, if you said everybody wants to be in the soft landing camp, and you're right. I mean, why not? Good news is better than bad news. So if we get good news and it looks like inflation continues to moderate, do we just keep buying stocks, given the S&P 500 is already up 8% this year?
Well, I think markets are a little bit ahead of their skis right now. I think stock prices are a bit inflated, and the CPI print today will have little effect on what the Fed does over the short term, but I think what the consensus has been pushing this pivot out. Maybe the fact that we were so enthusiastic that the Fed could start lowering rates this year, markets shot out of the gate like a cannon to begin 2023. In reality, that enthusiasm may be a little bit premature. So our base case is that for the next 3, 6, possibly as much as 9 months, we could be in a range-bound market. So I wouldn't be going all in with the euphoria that stocks are going to go up 7% every month and just compound into an incredible year. I think you have to remain defensive. There's nothing wrong with that. Our thesis is we're going to be invested, but let's look for a little bit lower beta names, cash-on-cash dividends. The stock market will go up. The Fed will pivot at some point for either a hard landing or a soft landing. I'm just not convinced that it's going to be this year. So I'd still be a little bit cautious, Brian.
Okay, Kevin, a follow-up to you first before I go back to Michelle. So do you think the gains, if we have gains, if we had gains for the year, are they in? I mean, we got 10 and a half months left to go. What are we going to talk about?
No, I think wherever the stock market is today is where it should be at the end of the year.
I'll just jump in. I think, Kevin, you're right in the sense that the truth is that the market has done a lot for now. And the real question about the Fed that we really need to know won't be answered until much later this year. I mean, they've done so much, they can do a little bit more. Then they're likely to pause and wait to see what happens. And whether or not they ultimately then have to go even higher than they think because inflation doesn't get all the way down to 2, or whether or not that's it and they can actually think about at some point pivoting. I mean, we won't know that until we get much later in the year and we see where inflation settles out. So I have to say, from a macro standpoint, the idea that we may be range bound for a period of time, makes a lot of sense.
And worst case scenario, Michelle, I'll leave you with this. If we get a hot CPI number and a cool producer number on Thursday, how do we read it? If they go in the opposite direction of each other, whichever way. Well,
the CPI always is more important in terms of what the market reacts. The Fed will actually like the PPI coming down because that is a leading indicator. It's wholesale prices that should give us a clue about future consumer prices. So from the Fed standpoint, that would actually be somewhat good news. But the market will take the CPI being hot much more than it will react to a low PPI report.